Charts. What are they and how can your trading improve by using them? A price chart is a sequence of prices plotted over a specific time frame. As you can see in the chart in front of us, from top to bottom vertically is the price range, and from left to right horizontally is the time frame. Traders use charts to analyze and forecast future price movements. While technical analysts use charts almost exclusively, it can also be of great benefit to fundamental analysts. A historical record makes it easy to spot the effect that key events had on a security's price, and by reviewing how these events affected the chart, they can prepare for similar events in the future. So how do you pick a time frame? Well, it depends what kind of trader you plan on being. If you want to day trade or intraday trade, you would look at the 1-minute chart, the 5-minute chart, possibly the 15-minute chart. If you're looking for longer term trades, you would look at the daily chart, possibly the 30-minute chart, maybe even the weekly chart. It all depends what you want to trade, but it makes no difference. The chart will always tell you what the price has done. Now in front of us we have a line chart. A line chart represents only the closing prices over a set period of time. The line is formed by connecting the closing prices over that time frame. So it's like a connect the dots. You have the closing price today, the closing price the next day, the closing price the next day, and so on. Some investors consider the closing level to be more important than the open, the high, or the low. And by paying attention to only the close, intraday swings can be ignored. Another type of chart is the bar chart. The bar chart gives you more information. The bar chart shows you the open, the high, the low, and the close, the OHLC. The open tells you where it opened. That doesn't tell you where it closed the day before. As you can see over here, it closed over here this day, and the next day it opened further down. If the bar is red, it means it went down. If the bar is green, it means it went up. Over here, even though the bar itself went up, but since it opened and closed below the close of the day before, it's a red bar. And finally, here's the candlestick. The candles also give you the open, the close, the high, and the low. The difference between the candle and the bar chart is that the candle has a body and shadows. The upper shadow goes all the way to the high, while the lower shadow goes all the way to the low, and the body itself, if it's red, depending on your software, it could be different colors. Red means that it went down between the open and close. If it's green, it means that it went up between the open and close. So that's the basics of charts. Charts will help you in your trading. I personally mostly use candle charts, and I recommend it. To know more about candle charts, you should read Steve Neeson's book about it.